And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning, welcome to the show. Of course, it's Tuesday. John Penn joining me today as well. We're going to talk about some stuff today. We've got lots of stuff to get into. Stuff's always important. We're also going to talk about, why the stock market party could be over, right? Got a lot of questions about an email that went out yesterday from a variety of different big firms talking about very low rates of return going forward in the markets. And so, this certainly got a lot of people concerned. And now everybody's wanting to know, is the party over? So we'll talk a little bit about that this morning. I mean, it's good commentary, so we'll get into that analysis from Goldman and JP Morgan and a couple other people. So anyway, yesterday, and interestingly enough, the leading economic indicators. So the Conference Board produces an index of 10 different indicators, and it's called the Leading Economic Index. And historically, this has been a very good indicator for the strength of the overall economy. It includes stock market prices, credit spreads, a whole variety of different things that all kind of suggest that, well, either the economy is doing well or it's not. And for years, this has been a pretty reliable indicator. When it's rising, the economy is tending to do very well. When it's falling, not so much, right? And coincidentally with that, when the leading economic index is declining and declining rather sharply on a monthly basis or a year-over-year basis, the economy's usually been in a recession, except this time. The leading economic index came out yesterday. It printed negative 0.5. for the month, which was a pretty big drop in economic activity. Now remember, this is a leading economic indicator. It suggests about what's happening in the economy over the next 6 months, right? So it's leading. It fell by about 0.5 yesterday, which is a fairly big drop. And that negative print yesterday is now the longest number of prints on record by far, historically speaking. 37 weeks that's been printing negative. 37 months it's been printing negative. 37 months we've had negative prints of the LEI index. That's the longest stretch on record ever. And it's the longest stretch of negative prints without the economy being in a recession. So it's quite interesting, right? You've had this extremely long stretch of negative prints suggesting that the economy should be in a recession or at least weakening rather sharply at this point for 37 months. And yet the economy just printed a 3% growth rate. Employment is remaining very robust at 245. You've got unemployment claims at very low levels. There's absolutely nothing going wrong with the economy. So either something is gone entirely wrong with the Conference Board's methodology, which it'll be interesting to see. Normally when an indicator like this kind of goes off the rails, we generally see whichever government agency come in and start tinkering with the data. The leading economic index has been adjusted before. They swapped out some indicators and inserted some other indicators. And so it won't be surprising that in the course of the next, year, that the leading economic or the Conference Board comes out and adjusts how their leading economic index is calculated, and they'll roll back, they'll do revisions to all the data based on this new formula, and we'll see, kind of what it looks like then. But again, it won't be surprising to see that. But the leading economic index is a very good indicator historically. And we've talked about this on the show before, the 6-month rate of change. So if you look at the data on a monthly basis and you look at the rate of change, right? The 6-month rate of change. Where was it 6 months ago? Where is it now? If that rate of change is negative, the economy has always been in a recession. Always. Except this time. This is one of those indicators like the yield curve. When the yield curve inverts, you've always had a recession. When the leading economic index is negative, you've always had a recession. This is one of those perfect indicators, the 6-month rate of change, except this time. So it's quite fascinating where we are in the cycle right now. All these indicators that suggest the economy's in a recession continue to be wrong. And we'll see. We'll see what happens. Okay, but let's talk about good stuff this morning. Here's what you need to know before the bell. Market is continuing to do just fine. That's what you need to know before the bell this morning. No, seriously. The market's doing fine. Absolutely nothing wrong. And again, this is interesting because markets have now gone, as we talked a little bit about yesterday, we've had a 6-week stretch of gains in the market so far. That's a fairly long stretch without some type of pullback, right? At least a negative week, right? You don't need a big correction, but a week of negative returns. So you've had 6 weeks straight of positive returns. A couple of things here just to kind of pay attention to, and tomorrow on the show, we're going to spend tomorrow doing technical analysis. I know that's just exciting for you guys, but tomorrow on the show we're going to go through very basic 101 technical analysis, so you'll have a little bit better understanding about what we talk about kind of in the mornings when we do our market recap. But the market is continuing to rise in a what's called a rising wedge pattern. In other words, prices are getting more and more compressed. As we continue to rise, the movement of the prices are becoming more compressed. And it's like, and we've talked about before, these wedges are like a spring. And so the more you coil the spring, they're going to break out to one side or the other. Given the fact that markets are overbought on a couple of levels, and we're kind of getting close to, but we're seeing volume start to pull back here on this rally. We're starting to see the MACD indicator starting to slow here a bit, starting to roll over. We're likely going to break to the downside. So this is going to give us that bit of correction. We're probably looking at end of the month, beginning of November, just post-election, if there's a bit of turmoil, whatever it is, see a bit of a correction pullback. That'll give you a better entry point to add exposure to your portfolios. Nothing really to worry about here, but again, we've just had a very, very strong advance here. There's been a lot of front running for the election. If you take a look at the markets itself, as we talked about yesterday, markets are right now running about a 71% probability that Trump's going to win. That's based on how markets are positioning in the markets right now. But there is a very aggressive move in terms of pricing for the markets as investors just continue to chase asset prices higher. Nothing wrong with that. But it does suggest that you're going to get a bit of a respite here somewhere. So just, this is just a decent opportunity. Take a little bit of money off the table, rebalance your risk. Nothing, again, just some basic gardening and pruning in your portfolio. And that way, when you do get some type of correction, which likely give you back to somewhere, in between the 100-day moving average, the 50-day moving average, somewhere in there. So you get 100, 150 points pulled off the markets. That gives you a much better entry point. And then, of course, as we talked about yesterday, the seasonal buy signal is in. So as soon as we get into November, you've got buybacks, you've got performance chasing, you've got a lot of end-of-the-year activity that occurs for stocks, which should lift asset prices higher. Once we get into next year, who knows? We'll get there. But that's kind of the setup right now. Does that mean that market has to work out that way? Absolutely not. If this election turns out into a complete nightmare, this market could sell off into the end of the year. Certainly possible. So again, you can't, and this is why we talk about risk management in the portfolios, because you can't ignore potential risk that something could go haywire and just completely mess up the market between now and year end. Again, but seasonally speaking, we're in a good setup. Technically, there's always risk, right? So manage accordingly and you'll do fine. That's what you need to know before the bell this morning. All right, coming back from the break, we're going to pick up with, is the stock market party over? That's what everybody wants to know. We'll talk about that next with John Penn. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So yesterday I got a couple of emails. One of them is that I should tell you to smash the like button on our video right before I do the daily market commentary. But I'm trying to watch the clock, think about what I'm going to say, because none of this is scripted. This is all up. We don't script any of this. It's all off the top of our head, right? So trying to watch the clock, think about what I'm going to say, all this, and so I forgot to tell you to smash the like button. But look, listen, we do tell you this a lot, but that like button, it's free to you. Right? Just to click that little thumbs up button and subscribe to the channel. It's amazing. We got a lot of people that follow our channel, but they don't subscribe. But that helps push our podcast through the Google algorithm and gets it out to more and more people. And we appreciate that. You help us by doing that because it helps us reach more potential prospects. And look, we're not going to lie to you. We're here. The reason we do the show every morning, yes, we're here to help you. We love to help you, but this is also our business, and we're trying to reach more customers. So if you can do us a favor and push just click that like button, it does help us quite a bit. We do appreciate it. So thank you. You guys mean a lot to us, especially in the chat. Y'all rambling in the chat, believe it or not, incoherent as it may be, that helps us as well.
It's coherent sometimes.
Well, except for Larry. But outside of Larry, yeah.
Larry's getting called out this morning. We love you, Larry.
I'm teasing Larry. I'm teasing you. I'm teasing you, Larry. Maybe if you're listening, if you're in the car, you can't do any of that. That's okay. Just keep listening to the radio show. We do appreciate you two very much. All of you help us, and we appreciate all of it. So, other email I got was from a gentleman named Jeff yesterday, and this was I had a whole thing scheduled for this morning, and I changed the topic when I got this email because it's a really good one. And by the way, just to let you know, we talked about the seasonal buy signal yesterday. I have an entire article on the website this morning on seasonality, why it works, what's the driver behind seasonality, Yale Hirsch's work. It's all on the website, realinvestmentadvice.com. It's today's blog. It's also on our Substack channel already. Actually, will be going out on Substack here in about 45 minutes. So if you're on Substack, you'll get it there as well. You can follow us everywhere. Substack, website, you name it. We're somewhere where you can find us. X, Twitter, whatever you call it. But got this email yesterday from Jeff, and it says, first Vanguard, then JP Morgan, now Goldman Sachs says the party is over for the next decade. Goldman's Costin is the most bearish of the three. I left out Taggart's Doomers with a smiley face. Could you speak of this on your Before the Bell show? So, Jeff, the problem is that it's more than a couple of minute conversation. And so I wanted to dedicate a little bit of time and discuss this with John Penn this morning as well, because I think it's a really good topic. Because we there's a lot of validity to what JP Morgan, what Goldman and others are saying. And then just so you know, there was a chart out yesterday from Goldman Sachs that says forward returns in the markets are going to be closer to 3% over the next decade versus 15% that they've been over the last decade. That's quite a drastic differential in returns. And of course, this has a lot to do. We talk about valuations, what you're paying for asset prices, has a lot to do with all that. However, the biggest driver of this is going to be the change to liquidity. And as we've talked about in the markets before, it's all about liquidity, 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 because that's what moves asset prices. Over the last 12, 13, 14 years now, we've just had this massive inflow of liquidity into the markets from either government interventions, zero Fed funds rates, quantitative easing, part 1, part 2, part 3, part 4, just $47 trillion worth of stuff thrown into a market. So you've gotten higher asset prices. And interestingly enough, people have gotten very used to these surging asset prices. And, you know, we get people that come in on a regular basis say, hey, I just want my portfolio to crank out 12% a year. Dave Ramsey says I can get 12% a year, so I just want that. That's not realistic, right? Markets don't do that over the long term. However, when you completely, flood the system with all kinds of central bank interventions and liquidity, it's got to go somewhere. Liquidity has to go somewhere, and it certainly doesn't go to improving economic prosperity for the masses, right? It goes into financial assets, and it creates rising asset prices. And today in particular, there's so much money flooding into the market, everything is going up. As we've talked about before, it's an everything market. So, gold's going up, stocks are going up, mid-cap stocks, everything's going up. It doesn't matter kind of what you own, it's all going up in price because all that liquidity has to go somewhere, and it winds up in asset prices. And it's always interesting because people try to fight the market and they're like, I'm very bearish the markets, I don't want to be in it, and it just continues to just drag them in. And that's how bull markets work. Bull markets work by dragging in the very last of the holdouts. Markets will rise until finally you have vanquished all of the bears, right? And we're working on that, right? There are very few surviving bears at the moment, and they are slowly being eaten away by this market. But over the next decade, that's going to be a very drastic difference, potentially, right? And again, it's hard to predict what governments are going to do, right? Or central banks are going to do. But if you just assume that we're not going to do HAMP, HARP, TARP, quantitative easing 1, 2, 3, 4, because right now Fed is still tightening their balance sheet, still doing QT, not QE. So if we just assume that we're not going back to that world, there is simply going to be less liquidity, which now that suggests when combined with high valuations, forward returns are going to be substantially lower than they have been in the past. Now, one last statement about this. That does not mean that you're going to get 3% a year every single year for the next 10 years. That's not what that means. There was this really great piece of analysis just recently talking about sequence of return risk. And this is something John and Danny and Richard all talk about with clients. What's better, a steady rate of return or a kind of a stock market type return, right? Or an unsteady rate of return. And so if you take and let's just pick 9%, that's the long-term average for stocks. Let's say for the next 10 years, you get 9% every single year, okay? At the end of that average is 9%, right? Because you've got 9% every year. If I lose 15% for the first 5 years and get 15% for the next 5 years, I wind up with a 9% return. So, it's doesn't matter how you get there. You can still wind up with an average rate of return, but you can have a lot of volatility. So when people talk about a 3% rate of return going forward, they're not talking about 3% every single year. They're talking about 15% in year 1, 10% up in year 2, a 20% decline in year 3, a 10% gain in year 4, a 20% decline in year 5. And when you get to the end of that, right, you get a 3%. lots of volatility and a very low average rate of return. See, and that's always the trick to this is people say, oh, the average return. You don't get average. You get all the squiggles.
Yeah, and if you're in distribution mode and you're taking withdrawals out of your portfolio in a year where maybe there's a 10% decline or a 15% decline, then you magnify that even more with your portfolio withdrawal. And I with plans and looking forward, we're all trying to predict the future. Nobody has a crystal ball. But you just look at where markets are. Arguably, they're expensive. So you have valuations that are high. So it just means you're moving forward. What sort of growth expectation can you have moving forward? Now, the market you never know. The market may give us, on a forward-looking basis, it may give us historical returns. It might. But do we want to plan on that? I can't tell you, Lance, how many folks that myself and our advisor colleagues here visit with where maybe they have a financial plan or retirement forecast put together by another firm, and the other firm is still to this day using a forward-looking return assumption in that 8 to 10% a year range. Well, yeah, you know what? If you're looking at retiring in a number of years, or you're in retirement now and you're taking portfolio withdrawals, and if you're making the assumption that your portfolio is going to compound and grow using historical returns of 8 to 9 to 10% and compound every year at that, yeah, guess what? Your plan's going to look great.
Right.
You won't run out of money.
Right.
But what if that doesn't happen? Let's just use a more conservative forward-looking rate of return, and if your plan can still be healthy with that, then we feel even better about your overall situation.
That's right. And look, I mean, and this is really key to what you're talking about. And I've written articles about life expectancy, and this is the one thing that all these advisors that kind of produce these kind of standard financial plans, they don't really consider. And when you talk about an 8% average rate of return over the last 124 years, you don't live that long. And I've done studies where I've done articles, things talking about life expectancy of returns over time. And for most people, you don't start investing until you're 35 or 40. So you're going to retire at 65. So you've got 20 years, 25 years to retirement. Most people, life expectancy has been increasing recently. Obviously, that's good. But you're not going to live forever. You're not going to live to be 124 in most cases, right? You're not going to live long enough to see that average rate of return. And, when people argue that case, all you have to do is sit there and go, I hear you, right? The market's been fantastic over the last 10 years. So if you were if you were 40 10 years ago, you're now 54, you are really set for retirement if you've just been dollar cost averaging the market. But what about those guys that were 55 years of age or 60 years of age getting ready for retirement in 1999? Their money did nothing, literally nothing, for 13 years before they started making money again in the market. See, it's those periods of very low returns that can devastate financial plans. When we come back, we'll talk about David Costin's and Goldman Sachs' specific comments about why they think returns will be low when we come back from the break. Obviously, valuations being the key. Be right back.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
And I've told you before about my dogs. They're 28 pounds. So I've got one that's half German Shorthair Pointer, half Terrier. The other is half Terrier, half Ashani.
The Real Investment Show podcast.
Little brown one. He is solid muscle. I mean, when he just sits still, his muscles are flexing and rippling right through his body. He's very muscular as a dog. Surprising me how strong that little dog is. So I now have new motivation at the gym.
Yeah. Same show, your schedule at realinvestmentadvice.com.
When I go to the gym, I have a picture of that dog because I want to look like him.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. Talking a little bit about is the stock market party over? I'll spit that out. There's certainly a case to be made for that, but it's not in the way that you think. And when I got this email from Jeff last night, and again talking about, we're starting to see more firms come out talking about lower forward rates of return, and immediately those with a more bearish bias are like, see, the whole thing's going to crash. It's all going to come apart at the seams. And it's the end of the world as we know it. It's the end of the world as we know it.
Great band.
Yeah. But that's not what that means. And again, it doesn't mean that you can't make money. It doesn't mean that, there's not opportunities. But you've got to be careful about extrapolating assumptions into something that it's not. And again, when you look at the market, and again, what David Costin and JP Morgan and all have come out and said is that basically over the next decade, bonds will outperform stocks. Not surprising. A lot of that has to do with the fact we're going to have much slower economic growth. That's going to impact things like commodity cycles are going to be worse going forward because as you have slower economic growth, there's less need for commodities. As AI comes into more fruition, that's going to increase the amount of people that are not employed in the population. And remember, we just don't count. There's about 100 million people we just don't count in the working labor force population. You'll have more of that. That will grow, right? Demographics are a problem going forward. We just simply don't have the birth rate. So there's a tremendous number of drags that are going forward that are going to be beginning to impact returns. And if you begin to extract more liquidity from the markets because you're not doing checks to households and UBI and these type of things, that's going to further slow down retail spending, consumption, which is 70% of the economy, right? So so that's how you get to these much lower rates of returns. You just go through a reversionary cycle within the economy, which is going to impact market returns. So again, when you start talking about forward returns, you have to start with valuations. And valuations are extremely elevated right now, as we talked about before. Forward returns right now on the markets are around 21 times earnings. That's the peak of the market, and forward returns, operating earnings, right, which are earnings X all the bad stuff, was at 24 times in 1999. We're at 21 times now. So we're not far off the all-time peak in terms of valuations on forward earnings. On trailing earnings, we're about 35, 36 times trailing earnings based on the Shiller K, which we were at 42 in 1999. So again, not far off the highs. Now, median valuations have risen over the last 25 years because we've had elevated stock market prices for a very long time now because of lower interest rate cycles and QE and all this type of stuff. So, no longer are you looking at a mean reversion to 5 or 6 or 7 times valuations like you saw back in the 70s, but a mean reversion in valuations back to 13, 14, 15 is certainly no laughing matter and will certainly contribute to that lower forward rate of return as that occurs. So again, it's something, we also have this as Goldman Sachs points out, we also have a very high level of concentration risk in the markets. We have just basically 10 stocks driving not just the market, but as we talked about yesterday, 10 stocks make up all of the earnings growth. So how can 10 companies continue, and if you just think about this, how can just 10 companies continue to drive the market returning 20, 25% a year, right? So as you look forward, there are definitely things to be concerned about, but that doesn't mean that we go hide out in cash, right? Because this is a decade we're talking about over the next 10 years, and every year is going to be different. It's not going to be 3% next year. It may not be 25% next year, like we're on, right now we're on pace to do for this year. But, returns next year could be 10% next year, that's going to be a terrible year.
Oh my gosh.
A 10% year is going to feel terrible, right?
Where's my 20? Where's my 25?
Yeah, exactly.
Come on.
But this is why, but John, back to you. This is why, in terms of planning and things going forward is, again, you go back and look at what happened in 1999, 2000. If you, I said, before, if you were 55 or 60 getting ready to retire, what if you were 45 and you go, oh man, I just want 10% a year. And if I'm 45 and I'm just doing the minimum to my 401k plan, but if it grows at 10% a year, I'll be able to retire at 65, and then 13 years of your life go past you and you made no money.
Right.
All of a sudden, all those retirement plans went out the window. And this is why we have to, evaluate, and we do this in our plans. We adjust for expected returns based on valuation levels and these type of things. And you need to be thinking about going forward, adjusting your assumptions on returns because of valuations.
Yeah, and maybe it comes down to maybe you need to work a little bit longer than what you originally anticipated, or it's very rare that somebody just gets up and they quote unquote retire fully. Maybe you aren't working as many hours as you were working before. Maybe you're consulting. Maybe you're working part-time. You still have some income coming in. Maybe it's not the amount of income that you were accustomed to, but you still have some income streams coming in, so you're not having to fully rely on the portfolio yet. And you're giving yourself some time to let your Social Security benefit kind of cook in the oven before you turn that on, and maybe you want to get the max benefit there. Talking about life expectancies, especially if you're married, sometimes that Social Security decision isn't just about you. It's about What happens if you should predecease? What about your surviving spouse and setting them up for their financial longevity as well? All these things that we think about. But even with plans, we can look at this and say, okay, well, what if you want to retire, let's say, at the end of this year, end of 2024, going into 2025? Not saying that this will happen, but what if you really retire into a real headwind? Or what if next year markets are down 10%? What if the market's down 15%? What if your portfolio is down, 10%, 15%? And what if in the following year you have you have 2 consecutive years of negative returns? How does that affect you? Does your plan still look healthy? If that were to happen, do you need to work a little bit more? I can't tell you how many times we put plans together, and at the going in towards the end of 2021, which is a really strong year, we were coming into 2022, and the expectation was in 2022, well, nobody knows what the future holds, but in 2022, the expectation was that the Fed was going to start raising rates. And markets didn't like that, so markets started peeling down in 2022. There are a lot of folks that we work with. They were ready to retire at the end of 2021, going into 2022. And even with the negative year in 2022, their plan was still healthy. Their plan supported what they wanted to do, but they said, you know what, John? I'm going to continue to work this year. I'm just going to stretch this out a little bit longer, let markets settle out. I'm going to get through 2022 and let's get into 2023. So they adjusted their plan. You gotta call an audible every once in a while and make those adjustments on a forward. And you got to do that, 'cause just like an investment strategy has to be fluid, the planning aspect of things needs to be fluid as well.
No, that's right. And again, this is one of the big, financial plans are a dime a dozen. You can do them yourself online. There's just tons of resources online. You can do your own you can build your own financial plan in a spreadsheet. And, but the biggest fallacy with financial plans, and I can't tell you how many times I see this, is somebody will come to visit and they'll bring in their financial plan that they got at some other firm, right? And it's got like dust on the cover, literally, because it's been sitting on a shelf for the last, 8 years, right? And I'm like, well, that's great. I said, how have you been doing compared to your plan? I don't know. It's just this big, thick book. It's got like 300 pages in it. Have you ever read it? No, not really. But the financial plan is only as good as the data input that you put in, and most importantly, you have to revise that plan every year because the data is changing every single year. The return this year wasn't what you expected it was going to be, and so you need to. Were you too conservative in your plan? Was was just a poor performance year in the markets? What happened relative to your plan? So you've got to adjust that plan And every year you have to update the plan. And the only way a plan works is you've got to adhere to the plan, and that plan has to be adaptable to adjust for changes in your environment. Did you lose your job? Did you get more money? Did you have a bonus you weren't counting on? That all impacts your plans. And so, this is all fine. And the problem when you start talking about these long-term returns at, 3%, whatever it is, again, they're not going to be 3% every year. Somewhere in there's going to be a 20% decline, a 15% decline, a 30% decline in markets, assets, whatever it is. You're going to have that decline. Well, that's when you sit down with your financial advisor and say, okay, we just went through that. How did that affect my plan? And what do I need to do next? It doesn't mean that you just tear up the playbook and go start a whole new financial plan. It doesn't mean you go swap advisors. It doesn't, because you're just jumping from the frying pan into the fire at that point. But this is why you have an advisor you sit down with and you approach this as a plan, as a path, and you're constantly calling audibles when you need to make adjustments for what's going on in the markets.
That's right. And I mean, to make this really fun this morning, these forward-looking rates of return that we're talking about this morning, those are nominal.
Oh, yeah.
Sorry. Those are not adjusted for inflation. Spoiler. Sorry. Those are nominal forward-looking returns.
All right.
Thanks, John.
Enough of that. Okay. But the bottom line is the party is not over, at least not yet. And we will deal with that when we come back. But when we come back from break, John's got a couple of questions we wanted to visit with this morning. So we'll talk about the dollar after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, John, you got you had a few questions from clients, prospects, et cetera, this week. One of them I thought was interesting, talking about the dollar. Mm-hmm. You received an email from a client saying, as usual, people like Jim Rickards and Porter Stansberry are at it to convince us that their recession-proof stock picks will be the only way to preserve real wealth, better than even gold. In any case, it's getting harder and harder to ignore the ultra-high U.S. debt where just the interest each year is larger than the U.S. defense budget. The dollar just doesn't seem like it can last since printing is the only tool the U.S. government will use. So does RIA have a good plan? So, the problem is, and as we talked about before, is there's a lot of fallacies behind these stories about the dollar and debt. Let's back things up for just a second. One of the narratives is always, well, it's a fiat currency. True. But here's a couple of things about this. The dollar, while it is printed currency, is backed by $500 trillion worth of marketable assets, market value assets, property, buildings, lands, oil reserves, you name it. So, yes, we have $35 trillion worth of debt. We have an economy that's growing at basically $28 trillion a year. So our debt to GDP is a little bit higher than economic growth. Not absorbently so, but certainly higher than we'd like. And what a debt to GDP ratio of about 15% or so suggests is that the economy will grow about 1% slower than it should normally because of that debt. But again, the currency is not at risk. And this is a chart. Here, let me make this bigger real quick, Brent, before you. Oh, you got it? Okay. Let me take this off then. This is a chart of the dollar since the financial crisis. All these stories. It's like, oh, the dollar's getting, the dollar's going away. Has been doing just fine, right? Because there is no place else to go in terms of reserve currency balances. And people, and this is why right now the U.S. stock market makes up 60% of global market cap. because everybody puts their money in the U.S. stock market. We've had massive inflows of foreign capital into the U.S. markets, bonds, stocks, etc., because that's where you store reserves, period. When there's issues of currency imbalances, as there is right now because the dollar's getting stronger, central banks buy gold because that's how you sanitize trade. Why? Because gold is traded in dollars everywhere in the world. You don't buy gold in yuan or in renminbi, whatever. Nobody wants that. They want dollars. So you trade gold in dollars. So there's multiple ways to basically store reserves. If I'm trying to get my reserves into the US dollar, I buy gold, I buy bonds, I buy stocks. That basically converts my reserves into the US dollar. So basically it's a bet on the dollar, and the dollar's getting stronger. So, John, this is the problem, is that there's so many of these fear-mongering narratives out there that really, our debt to GDP is actually declining. Our debt to deficit ratio is actually declining because economic growth is growing, right? Now, if we had no economic growth, it'd be a different story. But we've got fairly strong economic growth right now. Yeah,
and I think it's easy. The headlines are out there to kind of shock and awe, and they, everybody out there in the media, they want your points and they want your clicks and they want you to get on their sites and sell you and advertise to you and all those wonderful things. So when you hear these narratives or these rhetorics out there, it's very easy for that to kind of stir the pot where you go, oh my gosh, the dollar's dead. I'm going to take all my money out of the U.S. stock market. I'm going to sit in cash. And all of a sudden now 20 years goes by and you're still in cash and you've missed out some great opportunities along the way. But you kind of look at the headlines out there. Oh my gosh, countries they aren't buying our treasuries anymore. They're bailing out of the U.S. Treasury market. Okay, you got to take a step back, and you got to look at the noise and go, okay, is this valid? Is this a true statement? Let's just take a step back and look at the data. So actually, you can find directly from the Treasury, foreign holders of Treasury securities, and you can look at the trend. And you can check it out yourself. So you go to August of last year, from August of 2023 through August of this year, 2024, for the last year, the amount that is being of U.S. Treasuries held by foreign holders of Treasury securities has increased by $880 billion. So it hasn't gone negative. They're actually increasing their holdings of U.S. Treasuries. Mm-hmm. But you can't let the headlines scare you and fool you, because usually the folks that are out there painting that narrative, there's usually another reason behind it. Yep. Buy my book, buy my subscription service. Hey, just subscribe to this, buy the stocks that I'm recommending, go just pay so much per month. I'm not saying that's everybody out there, but you got to watch for that. Yeah, no, you got to take a step back and really kind of dive into what's the narrative out there and how is it valid.
Right. No. And look, I get tons of emails every day from people. It's like, I just saw this guy talking about, gold's going to go to 9,000. Okay, so I go click on the video link because I'm an idiot. So I click on the link, and it's some guy talking about how gold's going to go to $9,000, and when you look at who it is, it's a gold company, right? And so they're trying to sell you gold. And there's nothing wrong with that, right? I mean, everybody's in the prediction business, and this is why we talk every day. We're here on the show here's the morning bell, markets are going up. That's what everybody wants to know. Everybody wants to know what's going to happen next. I'm sorry. There is on CNN right now. There is a person that is trapped upside down in a crevice, having to get hauled out by paramedics and fire departments, etc. But somehow she was crawling down, upside down. She's crawling down into a crevice to get her phone back.
Hey, you got to get your phone. If your phone falls down a canyon, I'm going to go after it, right?
Yeah.
Oh, my goodness.
So anyway, but the point is just, look.
I just saw feet.
I know,
that's all I saw. I just saw the bottom of somebody's feet.
Feet are sticking out the top. Anyway, back to
it's not scripted, like Lance said. This is it. Sorry, y'all.
Not scripted. But no, the bottom line is just be careful. Look, and again, I'm accused all the time. Lance just talking his book. Yes, we own equities. We own gold. We own bonds. We own all these assets, right? And we manage portfolios. So, yeah, when I'm talking to you about the markets and what's going on, I'm giving you my views. And so, yes, technically, I'm talking my book. But we do buy and sell stuff, right? So, when things are not good, we will be selling a lot, and I'll be telling you, hey, got to get out because things are breaking, right? And we're not there yet. But again, just for your own personal investing, just understand the source of the material, and are the views driven by some bias? And the other thing you got to be careful of is people that are making predictions and making videos and all this other type of stuff that don't manage money at all. They're just out selling advice, and they're making their money off of YouTube or ads or whatever it is, but just giving you advice, but they've got no skin in the game. And you got to be careful about that too, right? So, John and I and Mike and Danny and Richard, we're all responsible for roughly $2 billion worth of client assets. So we have to be, we're neck deep in this game, and we're responsible for the livelihoods and welfare of a couple of thousand clients. And this is, we've got a lot in this. And so we've got to try to be right more often than we're wrong. Are we wrong? Absolutely. Sometimes we're absolutely wrong sometimes. But we have to be right more often than we're wrong, or we wouldn't have a business, but we'd also devastate. We have the risk of devastating financial lives. And that's the last thing that any of us want. Now, fortunately, we've never done that, but it's something that is very important to us.
Yeah. I mean, all of these risks out there that are on all of our minds, these are all risks that we, as your fiduciaries, and we don't take that word lightly, by the way. The fiduciary that's a big responsibility that we have to all of the individuals and families that we serve. But as your fiduciaries, we have to look at these risks that are out there on the horizon, not just from an investment standpoint in the markets and the economy, but changes in tax code, changes in estate planning laws, changes in rules that change on required minimum distributions, all of this kind of alphabet soup out there in the financial world. We got to keep all of this into consideration when we're meeting with all of the individuals and families that we serve. And everybody's situation is unique. It's different, right? But at the end of the day, it all comes down to managing risk. And I think a lot of us get very wrapped up in managing the risk of stocks to bonds to cash, and that's very important, but there are other areas of your life that need risk management as well, and that's the estate planning piece, tax efficiency, liability protection, all these other areas that we really want to dive into. So, but as a fiduciary, as Lance mentioned, there are lives that are at stake here, and we don't take any of this for granted because all the folks, and I said this the last time I was on the show, but there is a common theme. The folks that we work with and serve, none of this has been handed to them. You guys are out there working hard, saving money, and you want to make sure that your dollars are working for you to support your lifestyle moving forward. And it's our job to make sure that we keep you on track.
Well, except for Larry, who's just worried about whether or not the lady got her phone back.
Did she get her phone back?
We don't know yet.
Oh, we don't know
She's
yet.
still in the crack.
Oh, gosh. Get out of the crack. That's the theme. Get out of the crack.
All right. Hey, guys, thank y'all so much for joining the show today. We certainly appreciate you. Again, hit that like button for us. It really helps us out a lot. And tomorrow, I promise, we will dedicate the entire show to just basics of technical analysis. And I know I've been promising you for that a while. Danny's out on a hunting trip with some clients, so tomorrow will be a great day to do that. So we'll spend the show tomorrow talking about the basics of technical analysis. We'll just kind of go through some charts. We'll build them from scratch, so you'll kind of know how to do everything. So your homework tonight is go sign up for a free trial, or you can just get free access to stockcharts.com, because that's what we'll use tomorrow to make it all easy for everybody. All right, see y'all tomorrow on the next Real Investment Show. Have a great day.